Good morning, professional colleagues. Good morning, good afternoon, good evening, at whatever point you are picking up the video. So we are kicking off with revision at the moment. We are kicking off with revision. So we will be starting with the questions I sent on the group, and this is November 2019. November 2019, we're going to try as much as possible to solve all the questions here. Question 1 to 6, God help us. So the first question here is the compulsory question for 40 marks. 40 marks. 40 marks. But first, before you start reading the question, just go straight to read the requirements. Go straight to read the requirements. And here, A says that we should evaluate on financial grounds whether AL should proceed with the project. I know what will come to our mind is NPV. That's always the best method we can use when we're talking about evaluating on financial grounds. It could be NPV, and it could also be on some other models for us to evaluate. It could be based on APV. We could use APV. We could use the payback period. We have the payback period, the advanced payback period that deals with discounts, that deals with cash flow. It could be returns on investments. It could be returns on capital employed. You can use any of these models to evaluate on financial grounds. The only thing that will just trigger us to using any of these methods would be the information available. Then the B part that talks about we should discuss on financial grounds or discuss the appropriateness of the evaluation method used, and explain the assumptions made. So they've moved our assumptions to the B part. So just all the assumptions you can consider. All the assumptions you can consider when you deal with the A part is what you can discuss here. And then why do you think it would be appropriate enough to use whatever method you are using? If you are using NPV, let us know why you are using NPV. If you are using APV, you let us know. Majorly when we are using APV, we should be having a case of government intervention. Possibly the project is not just financed by equity alone, but is financed by debt, and the debt is also enjoying some government benefits with respect to subsidy. So APV will be a better method because APV will help us reflect the base case NPV and also the financing side. Because somehow NPV will not reflect the financing side. Because when debt is coming into a project, there are some benefits, especially when it is even further subsidized. There are extra benefits we can get that can help us improve the performance of the project. So there's every possibility in that regard that it might be better for us to use APV if we are dealing with the issue of debt. So that impact on the financing side will be reflected if we use the APV method. Then for your assumptions, just general assumptions that you know, but don't also give assumptions that are not specific to the question. And we will be talking about if we are looking at let's say it's an APV question. When you talk about the cost of equity that you used is ungeared cost of equity, because it has to be ungeared. It has to relate to equity alone. We look at APV as though it's financed, if we are dealing with the base case NPV, as though it's financed majorly by equity, that's 100% equity. So we have to definitely use cost of equity. And that cost of equity must be ungeared cost of equity because it does not involve debt. So you can just talk about the method you used in determining the ungeared cost of equity. Did you use the CAPM? Did you use the Modigliani and Miller's proposition? And did you use just the method that you used that made you arrive at the ungeared cost of capital? Then also you can discuss on your working capital. And this is just general knowledge now if you are dealing with APV. And the same thing also if it is NPV. The only thing is just that for APV, you discuss the ungeared cost of equity and the method. Then for NPV and APV, you can still discuss. You can still discuss. You can after that discuss on the working capital. What's your working capital requirements? What's your working capital requirements? What did you do to the working capital? Depends on what you also want to do to your working capital. Possibly, did you add your working capital to the cost of the investment? It depends on what you want to do. These are some of the general assumptions you can discuss. Then you can also talk about the rates used for debts. For debts, are you using the risk-free rates when you are trying to work on the financing side? And it has to definitely be the risk-free rates. Then you can also discuss possibly the area of tax allowable depreciation. That yes, for the purpose of investment, um, it is a tax allowable depreciation, machinery, plant, whatever assets, if it is tax allowable. And so those are some of the general assumptions you can just pick out. And as you're walking through the question, you begin to see some other assumptions like the interest, the inflation rate. You assume that yes, that sales or variable cost, whatever, possibly there's an inflation, is inflated at so and so percent. So that's just going to be a general assumption for that particular 5 marks. Then provide examples of ethical issues that may affect and when we're talking about ethics now, we should be talking about possibly health. We're talking about health. How will it affect the health, the project that they are moving into, and how will it affect the environment? Will there be bribes in carrying out the project? So generally, these are some of the things you consider, and which as I've said before, that please, as the exam is approaching, it's going to be very, very important as well too. It's going to be very, very important too, please, that you pick up your Pathfinder. Once you pick up your Pathfinder, read through the theory questions, go to the answer, and read the answer. It's as simple as that. You don't have to start carrying textbooks. Just pick up your Pathfinder, pick a particular year, read through all the theory aspects, and go and read the answer. It will give you a broader knowledge of how to attempt theory questions. Okay, then. Oh, okay. So, um, so let's just again go straight to this question on APV. On APV, let's see what we can do. So let me check. Okay. So let's go ahead now and then read through the question. So at least now we have an idea of what the requirement is all about. Okay. Oh, sorry. Hello. Hello? Hello? Is this, I'm just trying to check if it is very, very, very clear. Okay, so let's go back to the question now and see what they want us to do. Okay, so since we're having an idea like the NPV already, so Adibola Limited, that is called AL, is an unlisted company based in Akure. Okay. Over the years, the company has been producing and selling agricultural support tools. AL is now considering the production of sale of yam pounders. Oh, this man is, the company is into agricultural tools. Now he wants to move into yam pounders. There's a little bit of a diversification here. There's a little bit of move from its current industry to another industry. Okay? Although this is a completely new venture for AL, it will, in addition to the company's core business, okay, AL's directors plan to develop the project for a period of 4 years, then sell it for 24 million, then sell it for 24 million, okay, to a group of young investors. The government is excited. They have mentioned the government. The government is excited about the project. The government is excited about the project and has offered AL a subsidized loan. Beautiful. So now we're talking about subsidy. We're talking about government intervention. And basically the best form of financial analysis we can do based on the question we're asked to give is on financial grounds. So for us to assess if they should go ahead with this project, it's not going to be NPV, since we've seen the mention of government and also subsidized loan. In these two cases, we now have to work with APV. So since we're going to work with APV, exam sheets, your exam sheets. For exam sheets, for the exam sheets, you let's say this is your first page. Let your page 1 be for the base, say collect extra sheet as much as possible. Let it be base case NPV. Then you go to your second page, page 2. Let this be the financing side. The financing side effects. Then you go to your page 3. Your page 3 will now be workings. Workings. So as we read on the question, since we have that idea, the information that relates to financing side, we take it there. The information that relates to the base case NPV, we also take it there. Now that we have that idea. Well, we know that we're told that it's going to run for a period of 4 years. Okay. So our base case NPV will now be 4 from year 0, 0, 1, 2, 3, and 4. Since it's for 4 years. And we're now told that it will then sell this for 24 million. Now that 24 million seems to me as though it is going to be something that will happen at the end of year 4. Now you know the pro forma for your NPV. You know most times, in all cases, apart if we don't want to start with contribution, we can start with the sales. We know that we're going to have sales. Then very, very soon, we'll be having variable costs. Variable costs. We should be having fixed cost that is relevant, incremental fixed costs. We're just writing out what we know that will be part of this. Then we can leave a little bit of space. Since it's page 1, we can leave a little bit of space because investment and working capital comes after we've done all of this and calculated our tax. We calculate our profits, our tax. So let's leave enough space. And we'll just come here and say that space, investments. That's the capital that is invested, investment. Then from here now, we have working capital. Or let's just say we have sales. We have sales. We're told that the sales is how much? 24 million. Let's put it in thousands. 24 million. In thousands. 24 million. We're just trying to pick easy marks as much as possible. So that's the sales. We know that definitely we're going to be having working capital at the end of the day. Working capital. Okay, so let's read on. We've not done anything. We're just populating. Now here the government is excited about the project and has offered AL subsidized loan of up to 80% of the, so we need to find the investment funds, but we know it's 80% of the investment funds. So that information is going to be relevant for us under the financing side, but it's better we put it under our workings. So we know that, yes, there's going to be calculation for the base case NPV, for the base case NPV, and there's also going to be some for information we're going to need for the financing side. So for the financing side, we know now that we're going to be needing 80% of the investment. 80% of the investment. Here we're trying to make sure we don't leave any stone unturned. We don't leave any stone unturned. All right, so let's go back to the question and keep working on. So investment needed at the beginning of the project at a rate of 200 basis points, 200 basis points below the current borrowing at 300 basis points. 200 basis points below. That's amazing. So when we're talking about basis points, we definitely know that for us to determine it, it's going to be in percentage. It's going to be in percentage. It's going to be in percentage. And now that we know that we're going to be enjoying 200 basis points. Somehow, what is 200 basis points? 200 basis points is like 2%. Then above the 300 basis points. So what we need in here for this particular point is we need to know what is the government's debt yield. But I don't want us to start going down and up. Let's just be working with it as they are giving it to us. So we're just picking out that information. So we know that there is a savings. There's a savings. There's a savings, 200 basis points, 200 basis points. But we know that the normal borrowing The normal borrowing is 300 basis points above the government's above the government bond, above the government bond, above the government bond. All right. So let's proceed and see what we have here. So a feasibility study commissioned by the directors at a cost of 5 million has produced the following information. Okay, so there is a feasibility study now. For this feasibility study, this money has been spent. Let's not forget that when we're dealing with NPV and APV, we are working with cash flows. This 5 million will definitely be a sunk cost. This 5 million is a sunk cost. So it's not going to be part of our NPV or APV calculation. This money has already been spent. Whether they don't do the project or not, the money has already been spent. So we're not going to work with this 5 million. That can be part of your assumptions that the 5 million is a sunk cost and hence will not be part of the NPV or the APV, since we're working with APV at the moment. So let's go ahead. Now, the company can buy existing suitable factory. The company can buy existing suitable factory at a cost of 16 million. At a cost of 16 million, okay, payable now, that's the cost of investment. Then we also told that 4.5 million is required to buy and install the necessary plant and machinery. So I want to believe that this relates to our base case NPV. And what is the total? That's 16.5 plus 4.5. So we have our investment for the base case NPV, which is our first page here. Our first page here, which is going to be under the investments. So our investment here is now 16.5 plus 4.5. And this gives us a total of 21 million. So somehow we're trying to gather the investments because this investment also is enjoying 80% of government assistance. So let's go ahead. And so we're trying as much as possible not to get ourselves confused. We're just working with the way they give us the information. The way they give us. I'm trying to take my time on this. Okay. So let's proceed now. Let's proceed. All right. So now here we're now told that the company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling for an annual growth rate of 5% for the final year. Now, unit selling price for the first year will be 3,750. Wow. And will increase by, so let's start with this first. So it means that this information here definitely still relates to the cash flow, and that deals with the NPV. So let's go back, let's go to our workings and see what they are. So we are told that the sales would be 1,000 and this is a tick one. Yeah, the person is okay. So that means that we're going to have the workings for our sales. So financing side, so we'll just go straight to our workings. So now we have let's call it working one. Let's call it working one. Working one. Sales revenue. Sales revenue. Working one, sales revenue. So we have the number of years. We have year 1, year 2, year 3, and then year 4. We're told that the quantity that will be sold is going to be 1,300 in year 1, but we're further told that there's going to be an increase in the unit. Please take note of this. There's a difference between unit sales and sales revenue increase. You have to be very careful. If it is sales revenue increase, you have to first of all multiply the unit sales by the unit selling price per unit before you now begin to increase. But on unit sales is based on the volume. And in fact, the selling price per unit also has an increase relating to it. So we have to first of all increase our units set by 40% in each of the next 2 years and 5% for the final year. So it means that for this particular year, year 2 will increase by 40%. So I believe you know how to increase by 40%. Just multiply 1,300 by 1.4. You should be getting 1,820. Then you increase this also by 1.4, 2,548. They were now told that it dropped to 5%. So you increase this also. So this you increase by 40%. This you also increase by 40%. Then for this last year, you increase by 5%. So when you increase this, that's 1.05, you will have 2,675. Then the selling price per unit at the start of the year was how much? It was 3,750 to be increased by 3% per year. So 3,750 is for the first year, 3,750. Then we move on by increasing it by 5%, and that should give you 3,863. You increase again, this gives us 3,978. You increase by 5% as well, you have 4,098. So from there, we can now determine our sales revenue. Sales revenue, let's call this A, let's call this B. So this is going to be A times B. So A times B, this should now be giving us so when we multiply, we should be having a figure of 4,875, and this should be giving us 7,031. That's functional calculator 1,300 times 3,750. So by multiplying, so when you multiply it for the third year again, you should be getting 10,136, then 10,962. So we have our sales revenue, and for having the sales revenue, that will now take us back to our first page so that we can slot in those figures. We can slot in those figures. So we now have those figures. So you can see the way we are trying to populate this, our working. So here we have working one. So working one, we have for sales revenue, we have 4,875. We have 7,031. We have 10. Oh, sorry. That's some of the little mistakes we make when we are doing this. But we just have to be extra. We have to be extra careful. We have to be fast, and at the same time, we have to be extra careful. Okay, so for year one, it starts from year one. So for year one, we have 4,875. We have 7,031. We have 10,136, and we have 10,962. That's for our sales revenue. So we have dealt with this figure. We have dealt with this figure. We have dealt with this figure. So that's the best you can do so that you don't miss out on any of the information. Then further, we now know that in the first year, total variable cost per unit is 1,800. But this will also increase by 8% per year. So there's an increase in the variable cost per unit. The variable cost also moves with the level of activity. So we just go back to our workings and we go to workings 2. So we call this working 2. This is workings 2. Now for working 2 now, it is variable cost. Variable cost. And then the quantity sold. The quantity sold definitely will not still change. It works with the level of activity. And I'm picking it from the sales units. So 2,548 and then 2,675. Then the cost per unit, variable cost per unit here now. In this case, we have 1,800. We have 1,944. By increasing it by 8%, as we were told, then 2,000, that's 1.08, 8%. Then we have 2,267. So let me call this Q and then R. So we have the total now. The total now will be Q times R. So Q times R will give us 2,340, and this will give us 3,538, and this will give us 5,351, and this will give us 6,064. So we quickly take our figure, variable cost figure, we take it straight to our variable cost, which is our working two. Which is our working two. So we have variable cost working two, and that definitely this will be in jackets. So we have 2,340 and 3,538, and we have 5,351, and then have 6,064. Just picking it from that particular figure. So let's read on and see what is next. So we're told in the first year, the fixed overhead cost will be 3.725. And we can say 3,750, 3,750, of which 60% are centrally allocated. The fixed overhead will increase by 5% per year. Now, this figure we're told that 60% is centrally allocated. That's from the federal, from the federal government. Okay, that's from the head office, centrally allocated. And this 60% definitely is actually a non-controllable costs. It's a cost that we cannot control. In fact, it will definitely not be related to the project, because this was just allocated from the head office and they just give it to us and say, take, this is your own fixed cost. So 60% of this 3,750 cannot relate to the project. The remaining 40% is what we're going to use for our incremental fixed cost. So we're only picking 40% because 60% came from the head office. So 3,750 times the 50%. So, sorry, not 50%, 40%. 3,750 times 40%. So what is relevant to this project? Fixed cost is 1,500. And since we're told that it will increase by 5%, it makes it incremental fixed cost. So incremental fixed cost definitely will be a relevant cost under still the base case NPV. So we have our fixed cost in year one is 1,500 in jackets. Then we increase by, is it 5%? Yes, 1,575. As we were told from the question, that there is an increase of 5% per annum, 5% per annum. So here we have so increasing by 5% in jackets. Then what else we have? Increasing this by 5% as well. We have 1,654. Increasing by 5% as well, we have 1,736 by 5%. Okay, so let's proceed. Let's proceed. So you can see somehow we are done with this. We are done with this as well. So let's move on and see. Now, R will require working capital, of 15% of the anticipated sales revenue for the year at the beginning of each year. At the beginning of each year. Okay, so that's the start of year one. The working capital is expected to be released at the end of the fourth year when the project is sold. So we have another working again. So that's going to be working capital. Let's go back to our working. So we have working two. So now we have working three. Working three, which is our working capital. So what is the policy for this working capital? We're told that it is 15% of the anticipated sales revenue. Okay, anticipated sales revenue 15%. So from year one, let's just go from year one. Let's just say from 0, year 1, year 2, year 3, year 4. 15% is the benchmark of anticipated sales. So our sales here, what is our sales figure from the beginning of each year? Our sales figure is, okay, revenue is 4875. These are the figures we need. These are the figures we need, 15% of this figure. So 15% of 4875. Let's punch our calculator. Let's punch our calculator. So 15%, 0.15 times 4875. So this gives us, oops, it's giving me syntax error. 0.15 times 4875. So it gives me approximately 731. So 15% of that figure gives me 731. So when you do 15% of the sales in year 2, that should be giving you 1055 approximately. Sales figure 15% in year 3, that should be giving us a figure of 1520. And then in year 4, we're told is 1644. Now, when we're now told that if we are to now look at the working capital movements, the working capital movement, you will discover that for this particular year now, this is from year 0 to year 1, we needed 731 working capital in year 0. From year 0 to 0, there was an increase. So that means that it showed that we needed 731 in year 0. Then let's look at it from 731, because from now 731 to an increase. This is 731 increase. This shows that we need more working capital. And the difference here is 324 in year 1. So these are the incremental cash flows. Then as well again from 1055 to 1520, there was an increase, which showed that we're going to also need more working capital in year 2. That's the difference, should be 465. From year 2 to year 3, there's going to be a need 124. And then because we're told that it's going to be settled at the end of year 4. At the end of year 4, just add these figures together: 731, 324, 465, and 124. We're going to be releasing it in year 4. We're going to somehow return back the working capital in year 4. So for working capital, this is what we work with on the incremental basis. So an extra working capital needed, and definitely we're going to need working capital at the start of the year. So like that, there's been an increase. And at the end of year 4, we're going to release the working capital, because it's just, my working capital is just the money we need to run the business. And after the end of the business, we should be able to return the working capital. So that's the working capital structure. And I said before, so we just quickly go back to our workings in our first page. Since we know that working capital, we've been able to put it there. It comes always at the end. It doesn't affect it. After investment, you put, so in year 0, our working capital is this is in jackets. This is 731 in jackets. 731 in jackets for working capital. Then okay, let me adjust this thing to 21. So working capital in year 0 is 731. In year 1 is 324. In year 2 is 465. In year 3 is 124. And we're told in year 4 is going to be released. That's 160, 1644. Our sales is 24,000 in year 4, which is an inflow. So we're picking it one after the other. So let's go ahead and AL's tax rate is 25% per year on taxable profits. Okay. Tax is payable in the same year. So that's year 1, year 2, year 3, year 4, as when the profits are earned. If we're told that tax is paid in arrears, tax is paid in arrears means that the tax will start from year 2. It starts from year 2. If tax is paid in advance, then it should start from year 1. It should start from year 1 because you're paying it at the beginning of the year. So which still runs within that, but this is always a very dicey one. There's always a very dicey one. But if it is in arrears, then it should be paid in year 2, the start of year 2. If it is paid in advance, it should be paid in year 1. So now this is still the same thing, the same year. So starting from year 1. So it is anticipated that the value attributable to plant and machinery after 4 years is 600. Okay, this is like the scrap value, If okay, of which the project is sold. Oh, okay. So it is anticipated that the value attributable to plant and machinery after 4 years is 600 of the price, 600 of the price at which the project is sold. Okay, the project was sold for how much? It was sold for 24 million. So since it was sold for 24 million, it means that 24 million, this particular 24 million, the 600,000 is inclusive of that figure. But we just know that there is a scrap value that relates to, plant and machinery. Where is it again now? There's a scrap value that relates to plant and machinery. So we don't need to include it in our NPV calculation because it is already inside the 24 million. Possibly we might be needing this figure for something else. So we know that plant and machinery scrap is 600,000, okay? And we know that tax rate is 25%. Oh, okay, let's deal with this before we move on. So AL's tax rate is 25% per year on taxable profits. Tax is payable in the same year. Then we're told that tax allowable depreciation is available on plant and machinery. Okay, on plant, so it's only on plant and machinery. Okay, so that's going to be our workings again. Let's quickly go to our workings to see how we're going to deal with the plant and machinery. So this is going to be working 4. It's going to be working 4. So tax allowable depreciation scrap is 600,000. Then what is the cost of the assets? It is only on plant and machinery. And we're told that plant and the machinery is 4.5 million. Is 4.5 million. So we can find our depreciation here. So to calculate depreciation on this should be 4.5 million minus 600 because it has to be the cost of the assets minus the scrap divided by the number of years, which is 4 years. So let's first of all find the depreciation on it first. So 4,500, 1 to 3, minus 600, 1 to 3, divided by 4. So the depreciation on this is 975,000. 975,000. This is the depreciation. So now we're told that it is actually tax allowable. So what we can do, we can use 2 methods to determine this. We can decide to, what we can do is just we can decide to find, I'll show you what we can do now. We can just go ahead and find out, let me just use one of these. We can just go ahead and determine our profits. Our profits, let's call it, it's going to be cash profits because we have excluded all the relevant this thing there. So it can be cash profits. So when you add this, you should be having a total figure of 1035. Then you can decide to calculate your tax. Tax is actually 25%. 25% of this figure will be 259. Will be 259. with 259. With 259. So this here is the tax. But don't forget that we have not excluded the tax allowable depreciation. So what we can do now is for us to now, it might really give us a little bit of issue. So what we now need to do is for us to now add up our tax savings, the tax savings, because that tax savings should reflect. So when we add our tax savings is now going to be based on the depreciation. What is the depreciation? The depreciation is 975,000. 975. So we can calculate our tax savings on this figure, 975 times 25% to determine our tax savings. So if you do 975 times 25%, you'll be having 244. You'll be having 244. This is 244. That's the tax savings. So let's go back there and do tax savings, 244. So our tax savings definitely is going to be 244 all through. We are adding it together, 244. So if you look at this 259 and 244, there's going to be a difference there. The 259 is much more than the 244. So that difference, let's do it now. 259 minus 244 is a difference of 15. So this 15 now is actually the tax we are calculating. We are working with 15. Or you can do it this way. Since this figure is 1035, 1035. Now we were told that depreciation, because the point is just that for assets, yes, there is depreciation of assets. But they are telling us that you cannot, depreciation is not a cash flow item. It's not a cash flow item. So depreciation should be somehow removed. It shouldn't be part of the calculations. It shouldn't be part of it. So what we can do in this particular case is we can now remove depreciation, because on a good day, if we are looking at depreciation, is an expense generally in the financial accounts books, and depreciation is always deducted before we say we want to determine our tax. But here they are telling us that depreciation is not a cash flow item. It won't be proper for you to remove depreciation that is not a cash flow item before you calculate your tax. So what they now do when we're looking at investment appraisal is that they now look at, okay, what can be a proper figure of depreciation, just like the capital allowance in tax. So they give us that capital allowance in quotes that we can now remove from our profits. Then we can now calculate our tax. But that is not all. The moment we do that calculation, that figure should be added back. The figure should be added back. So what we can do is this. We can easily work with this 1035. Let me just do it here. 1035. Let's remove that depreciation of 975. By the time we remove it, we're not doing that, we're not doing the reduction here. We can just take it to our working speech to determine the proper figure. So we can just remove this from this now. So this is the tax allowable depreciation that we feel should be removed before we calculate our tax. So 1035 minus 975, we have a figure of 60. So we can now calculate our depreciation, our tax on this. So 25% of that 60, this will also be giving you 15, which is the same 15 we got here. So you can decide to use two methods, anyone you decide to use. You can just calculate properly the cash profits, calculate your tax on this. The moment you calculate your tax on this, the next thing you need to do, this is the tax now, is for you to add the tax savings. The tax savings is 25% of the depreciation figure. And the depreciation figure is 975,000. And it is a good one because our depreciation figure is actually on straight line basis. So that's why we can just work with that figure all through. But if it is on a reducing balancing method, you might now want to work with the second method. That would just be your workings 3 or your workings 5 or workings 4. You just bring those profit figures down here. The profit figures in working 4, which is the profit figure we arrived at 1035, 1918, 3131, 3162. Then you can now deduct your depreciation if it is on reducing balance. Though depreciation here is just 975. But if it is on reducing balance, then you can now begin to put all the depreciation figure here reduced to their reducing balance. But this is just the same figure, 975. So here you can decide to remove the depreciation. Then whatever answer you have left, you now calculate your tax, 25%, which is 15. Now take the 15. It's only the 15 you now take back to that your first page. So whichever method you want to use, this is the first method. You bring your profit down here, remove your depreciation. The answer you get, you calculate your tax. Just don't have to do any other thing. Just take that tax figure. Just take that tax figure below your 1035 here, 15, and the other figures. You don't have to do any other thing. Or you can just calculate your profits, calculate your tax, 25%. This is your tax. Then you add back the tax savings, which is 25% of the depreciation. Even if it is on reducing balancing method, it's going to be 25% of those depreciation for each of those years. So please, in case you don't understand this part, get back to me. So let me just work with this particular method, working with the tax savings. So my cash profit here is 1918. Then the tax on it is 480. Then the tax savings is 244 because it's easier for me. You can also try to work with the second method and see if you will get the difference between this and this. So for the third year is 3131. Then here we have 783 in jackets, then 244, the tax savings. Then my profit here is 3162. 791 is the tax. Then the tax savings is 244. Is 244. So in that regard, we have dealt with this part, that part. Okay, so let's look at if there's any other information. Okay, so I think now AI uses 12% discount rates for new projects, but feels that the rate may not, so we can't use 12% now, will not be appropriate for the new type of project investment. It tends to raise full amounts of funds through debt finance and take advantage of the government's offer of a subsidized loan. So here we're given the issue costs. So now this one now is relating to the financing side effects. So I want to leave the financing side effects for the next video, but let's see what we can do. I think we don't have any other information that relates to the base case NPV at the moment. Okay, so what we now need to do is for us to, let's now see what we can do. Let's add up all our figures in this particular part here. Let's add up all the figures. So we don't have any other information in that regard. So let's add up all the figures and see what we have here. So here now, and the total here for year 0, so we're giving us a figure of 21,731. And for this figure, we should be having 696. For this figure, we have 1217. For this figure, we have 2468. For this figure, we have 28,259. 28,259. So we need a discounting factor. Now the discounting factor should be based on GA, cost of equity. Don't forget, I didn't say cost of capital. I said cost of equity. Now, please go back to the question. Go back to the question. Now the information here, we are told that we cannot use 12%, so we can't use 12%. They now further give us some information. Although no other companies produce yam powders in the country, Kaseki also produces cassava. This is a proxy company. So it means that we have to now begin to look for a proxy company that also is in that similar business. We might now begin to look for how we can get their own cost of equity. Now, if this information will stress your life in the exam hall as regards to time. You don't have to stress yourself sorting this one out. Just go back to your, because you're not asked to even calculate cost of equity. This is what you are doing feasibility study. Just assume 10%. Then you go to your assumption and state it that my assumption is based on 10%. But for the sake of this video, I will show you how we can get the ungeared cost of equity. So we can just assume a 10% and go ahead, because you still have the financing side to touch. You have the financing side to touch. So just pick your assumption, just pick a rate and state it in your assumption so that you can go ahead and conclude this question. But for the sake of this class, let's see what we can do to this particular question in this area. So here we're told that yes, we have CL. We have CL who is in another industry that we can use. And we're told that CL's cost of equity is estimated to be 14%, okay? And it pays tax of 28%. Then CL has 15 million shares in issue, trading at 2.53 each, and 40 million bonds trading at 94.88. Then we also further told that the 5-year government bond is estimated to be this, and the market risk is estimated to be this. Okay, so what we can do, and what we can do is that, well, we can decide to use CAPM because I'm saying market risk premium, and I'm saying the government bond. So we can decide to use the CAPM, but here we're given the cost of equity. The cost of equity to be 14%. Okay, what will the CAPM help us derive? So let's go to our next working, because we need the ungeared cost of equity. The ungeared cost of equity, and that cost of equity given to us there, cost of equity given to us there might be, because well, if we have the CAPM, let's say we are using the CAPM. We're using the CAPM here. Now the CAPM is the way it's been defined is risk-free plus equity beta. Don't forget equity beta into bracket risk-free minus market risk or market returns minus the risk-free returns. So this gives us our cost of equity. Normally, the cost of equity is always based on beta equity. Beta equity carries business risk and also financial risk. So it means that the information given to us about this proxy on CAPM should be reflecting the business risk and the financial risk of this proxy company. What we need is just the business risk, which is the beta asset. But we're given the cost of equity to be 14% from the question. 14% is equal to, sorry, I'm just trying to, okay. 14%, we're given 14%, yes, 14%, and we're also given some other information. Do we have the risk-free? Yes, we have the risk-free to be 4%, and the government to be 4.5%. So risk-free is 4.5%, 4.5%, plus we need to find their beta equity. And they also give us, this is risk market returns minus risk-free, will give us the premium. Will give us the premium. And we're already giving the premium to be 4.5. So in this case, we can find our beta equity, making beta equity the subject of the formula. So here we'll have 14 minus 4.5 divided by, what's the risk premium? Sorry, did I say 4.5 again? The risk premium is 4%. Sorry, risk premium is 4%, not 4.5. So it's 4%. So divided by 4. This will give us our beta equity. So beta equity here now, by the time you punch your calculator, you'll be getting a figure of 2.375 for beta. This is now our beta equity. This beta equity relates the business risk and the financial risk of the proxy, because we're using the proxy information. So what we now need to do is, for us to ungear this beta equity with the proxy's information. And we have a formula for ungearing. For gearing, we have beta assets is equal to beta equity times the value of equity all over the value of equity plus the value of debt into bracket 1 minus t plus beta debt times the value of debts into bracket 1 minus t all over value of equity plus value of debt into bracket 1 minus t. So here now with the beta equity of the proxy CL, or ZCA now, beta equity of the proxy, we can use their all financial information to ungear this beta equity to have the beta asset of the proxy. So we just go ahead and since beta debt, we have no information on beta debt is 0. So we can cancel this one out. It's already 0. So to find our beta asset will be what's the beta equity we just found now? Beta equity we just found now is 2.5. 2.5 2.533 2.533 2.375. That's our beta equity. How about the value of equity? How about the value of debts? We need to find that using the information given to us about the proxy. So what's the value of our equity? We were told here that CL has 15 million shares and it is trading at 2.53. So automatically, the value of equity here will be 15 million shares times 2.53. And that should give us a figure of 37.95 million. 37.95 million. How about the value of debt? We were told that the bonds is we have bonds to be 40 million trading at 94.88. So the value of bonds or the value of debt would also be 40 million times 94.88 divided by 100. So that should give us a figure of 37.995. Well, it's getting so close to that. So our beta asset now would now be equal to 2.375 times the value of equity in the formula, 37.95, divided by the value of equity still from the formula, 37.95 plus 37.952 multiplied by, we are given the tax rate, 1 minus 0.28. So by the time you punch your calculator, you should be getting beta asset of 1.3808. 1.3808. We have 1.3808. So we can now go back and we can still work with the same CAPM. But this time around, we're going to be using the beta asset. Now the CAPM will now be restated as risk-free plus beta assets into brackets, the market returns minus the risk-free rates. So because we're having beta asset here now, the cost of equity here will now be called ungeared costs of equity. Ungeared cost of equity. We have the risk-free given to us before to be 4.5 plus we are using our beta equity now. So the beta asset now 1.3808 multiplied by what was given to us before as the premium 4. So if you punch your calculator size and mass, you'll be getting 10.023%, approximately 10%, which was what we already assumed in the first place. Now, this part will take our time. Well, there might be a little bit of mark given to us on this. If the time is there and you're fast, go ahead. But if you don't have the time, this is not what you have been told to do. You have been told to do the financial feasibility, state your assumptions. You are a strategic financial manager. You should be able to take very decisive decisions as well also. So we can still go ahead and use them. Though we have some other methods we can use to determine this particular 10%. I will show you in the next video. So let's assume now we're using 10%, as we have already concluded. So for us to now sort out conclusively the base case NPV, we are using 10%. So 10% in year one. I want to finish this before I save the video. So 10% in year one. In year zero will definitely be 1. In year zero will be 1. In year one, it will be 0.909. In year two, 0.826. In year three, 0.75. In year four, 0.683. So we multiply to determine our base case NPV. So here we have 19,301. Here we have 1,853. Here we should be having 1,005. Here we should be having 633. And then in jacket here, we should be having 21,731 in jacket. So by the time we add up everything, our base case NPV should be giving us 1,061,000 naira. That's a good one. It's positive though, but we still have to consider the financing side. So, class, professional colleagues, I want to believe that with these few points of mine, you now totally understand the base case NPV. I'll be saving this video so that I can quickly send it to you. We'll see again in the next video. Thank you so much. Success in your exam. This is Cornerstone Accountancy Professional. And in case you want to get in touch with me, my name is Adekunle Adebinkwe. Yes, by God's grace, I am a chartered accountant with the ACCA, and this is my phone number 0812-8130-406. To your success, in Jesus' name, amen.